The death of cheap logistics. $2.60 trillion. That is the current price tag of the United States logistics network. 8.8% of the entire national GDP. On November 1, 2025, the rules of engagement changed forever. A 25% tactical strike on import prices. Class 8 heavy-duty trucks, the backbone of American supply chains. Overnight, the cost of sovereignty went up. This is not inflation. This is a structural realignment of the industrial base. Fleets are freezing orders. Dealerships are scrambling for inventory. The era of globalized low-cost freight is officially over. Secure your supply lines. Protect your margins. Welcome to the new economic perimeter. The battlefield is no longer just about interest rates or consumer demand. It is about the physical hardware that moves the American economy. We are talking about the Class 8 tractor-trailer, the absolute apex predator of the logistics world. These are not just vehicles. They are rolling industrial assets, complex systems of steel, aluminum, and semiconductors that define the velocity of commerce. For decades, the strategy was simple: source the cheapest components from the global market, assemble them wherever labor was most cost-effective, and flood the U.S. interstate highway system with affordable capacity. That strategy has been decommissioned. The primary weapon system in this new theater is the Section 232 Tariff, a legal instrument honed for national security, now deployed with surgical precision against the heavy-duty truck market. We are looking at a landscape where the arsenal of democracy is being forced to rebuild its own foundry capabilities. But the transition cost is being paid in real time by every logistics manager from Laredo to Detroit. Consider the asset itself. A modern Class 8 truck, a Kenworth T680, or a Freightliner Cascadia, is a beast of engineering. It relies on a global supply chain for its very existence. The frame rails require high-tensile steel. The engine block demands precision cast iron. The transmission, the axles, the cooling modules, these are the critical organs of the beast. For years, a significant percentage of these components, or the fully assembled units themselves, crossed the border from Mexico, Japan, or Europe. The sheer volume is staggering. Imports from Mexico alone had tripled since 2019, reaching over 340,000 units annually. This flow of hardware kept the initial purchase price of a fleet manageable. It allowed carriers, operating on razor-thin margins, to cycle their equipment every 3 to 5 years. That cycle is now broken. The hardware is no longer a commodity. It is a protected species, and the cost to acquire it has surged effectively overnight. The protectionist perimeter was established to shield giants like PACCAR, the parent of Peterbilt and Kenworth, and Daimler Truck North America. The logic is sound from a sovereignty perspective. You cannot rely on foreign entities to build the vehicles that move your food, fuel, and medical supplies. If the border closes, the trucks must still roll. However, the immediate tactical reality on the ground is a shock to the system. We are not just talking about the sticker price of a new tractor. We are talking about the total cost of ownership, or TCO, a metric that haunts the dreams of every fleet operator. When the capital cost of the asset spikes by 25%, the amortization schedule blows up. The cost per mile increases. The freight rates required to break even must rise. The entire mathematical foundation of the trucking industry is being rewritten under the pressure of this new tariff policy. This did not happen in a vacuum. The intelligence signals were flashing red long before the November 1st deadline. Early in 2025, analysts monitoring raw material indices saw the precursors. The cost of domestic steel and aluminum had already begun to climb, driven by the expansion of earlier tariffs to 50% on specific metallurgical imports. These were the early warning shots. Industry insiders at the Technology and Maintenance Council meetings were whispering about supply chain hardening. They knew that the just-in-time model was fragile. They watched as the geopolitical rhetoric shifted from free trade to fair trade and finally to industrial security. The smart money started moving early, locking in orders for 2025 deliveries before the cutoff. But for the vast majority of the market, the realization came too late. They were tracking freight volumes, which were soft, instead of tracking trade policy, which was hardening. The detection of the threat was complicated by the complexity of the supply chain. A US-made truck often contains a transmission from a subsidiary in Mexico or electronics from Asia. The tariff policy didn't just target the finished unit. It targeted the ecosystem. Parts shortages began to appear as suppliers hesitated, unsure if their components would be hit by the 25% levy or if they could qualify for the USMCA exemptions. This uncertainty acted like a jamming signal on the radar of procurement officers. They couldn't calculate the landed cost. They didn't know if a brake drum or a steering knuckle would cost $100 or $125 next month. In a business where margins are measured in cents per mile, that uncertainty is paralyzed. The signals were there: the rising producer price index, the aggressive rhetoric from the White House, the frantic lobbying by the U.S. Chamber of Commerce. But the inertia of the status quo kept many operators from taking defensive action until the missiles were already in the air. November 1st, 2025. The deadline hits. The atmosphere in the customs broker offices at the Port of Laredo is electric. It is 0:01 hours. A convoy of car haulers, loaded with brand new heavy-duty units manufactured south of the border, approaches the inspection lanes. These are not just trucks, they are financial liabilities. The moment they cross that line, the 25% duty applies. The digital systems at Customs and Border Protection update instantly. The brokers stare at their screens. The duty bill for a single shipment jumps from a manageable operational expense to a capital crisis. A truck that cost $150,000 yesterday now carries a tariff burden that pushes its effective price into the stratosphere. The phones start ringing. Fleet managers in Dallas and Chicago wake up to emails confirming that their Q4 acquisition budget is effectively dead. The chaos spreads to the dealerships. Sales representatives for major OEMs are forced to make the hardest calls of their careers. They have to tell long-standing clients that the price protection they thought they had is gone. Force majeure clauses are invoked, contracts are renegotiated or canceled. On the lot, the inventory that sits there suddenly becomes more valuable, like gold bullion in a vault. Used truck prices, which had been softening, suddenly find a hard floor and bounce. If you can't afford the new iron with the tariff tax, you buy the old iron. The frantic search for domestic vangs begins. Every truck with a Made in USA plate on the door jamb becomes a strategic asset. The market shifts from a buyer's market to a desperate scramble for compliant hardware. Inside the boardrooms of the large carriers, the Werners, the Knights, the Swifts, the mood is grim but calculated. They run the numbers. They look at the offset program, the 3.75% rebate offered for domestic assembly. It is a drop in the bucket compared to the 24% production cost increase estimated by FTR Transportation Intelligence. They realize that the math doesn't work for fleet expansion. The strategy shifts instantly from growth to sustainment. They cancel orders for expansion units. They extend the life of their current fleet. They pour money into maintenance, deciding to rebuild engines and replace transmissions rather than buy new trucks at the inflated tariff price. The service bays fill up. The demand for parts also skyrockets. It is a grinding war of attrition against depreciation and mechanical failure. The ripple effect moves downstream to the shippers, the retailers, the manufacturers, the grocery chains. They are told that freight rates must rise. Not because of diesel, not because of driver pay, but because the cost of the chariot itself has gone up. The friction in the economy increases. Every pallet of goods moving down I-35 or I-80 now carries a fraction of that tariff cost. The inflationary pressure the economists talk about is actually the sound of the logistics network grinding its gears, trying to find traction in a world where the hardware is suddenly scarce and expensive. The ports on the West Coast see a dip in volume as importers try to route goods to the East Coast to minimize overland trucking miles, trying to save pennies to offset the dollars lost on equipment costs. The chronological fallout continues through the quarter. By December, the smaller independent owner-operators are feeling the squeeze the hardest. They don't have the capital reserves to absorb a $40,000 price hike on a new rig. Many are forced out of the market, selling their authority, or leasing on two larger carriers. The consolidation of the industry accelerates. The mom-and-pop trucking companies, the heart of American agility, are crushed between the anvil of low spot rates and the hammer of high equipment costs. This is the collateral damage of industrial policy. The weak are cold, only the capitalized survive. The landscape of the American road changes. Fewer new trucks, more aging equipment, a grittier, harder operational reality. But amidst the smoke and the wreckage of the budget spreadsheets, a new structure begins to emerge. The OEMs, the PACCARs, and the Daimlers start to adjust their firing solutions. They announce massive investments in U.S. manufacturing capacity. If they can't import it cheap, they will build it here. Ground is broken on new axle plants in the Midwest. Casting foundries in Ohio are dusted off and brought back online. The reshoring is no longer a buzzword, it is a survival imperative. The supply chain managers who were screaming about costs in November are now, by January, signing long-term contracts with domestic suppliers. They are securing their flanks. They are realizing that while the price is high, the security of supply is higher. They are trading efficiency for resilience. The message is clear. The days of relying on foreign industrial capacity to move American goods are over. The tariff is not a tax, it is a wall. Inside the wall, prices are higher. Yes, but inside the wall, the factories are running. The mechanics are working. The steel is being poured. The U.S. logistics network is becoming a fortress. It is a heavier, slower, more expensive beast, but it is one that cannot be shut down by a diplomatic row or a blockade in a foreign ocean. The sovereignty of the supply chain has been purchased with the cash flow of the trucking industry. This is the new reality. The historic surge in truck prices is the entry fee for the new era of American industrialism. It is a painful extraction of value from the logistics sector to fund the rebirth of the manufacturing sector. For the men and women on the ground, the fleet managers, the dispatchers, the drivers, the mission remains the same: deliver the load. But the tools they use are now weapons in a larger economic war. The cheap fleet is dead. Long live the sovereign fleet. We are witnessing the hardening of the American artery. The $2.6 trillion logistics bill is the cost of doing business in a world where security trumps efficiency. The 25% tariff is the new baseline. Do not expect it to go away. Do not expect prices to revert. Adjust your rates, tighten your belts, maintain your equipment. The ride is going to get rougher, but the road is ours. This is the fallout. This is the shift. Stay alert, stay sovereign. The implications extend far beyond the balance sheets of the trucking giants. We must look at the granular level of the components themselves to understand the depth of this shift. Take the semiconductor shortage that plagued the industry in previous years. Now, imagine that same scarcity applied to steel chassis rails and aluminum cab structures. The 50% tariff on raw steel and aluminum, which preceded the truck tariff, had already primed the explosive charge. When the 25% vehicle tariff detonated on November 1st, it created a compounding effect. A domestic manufacturer, trying to ramp up production to meet the sudden demand for tariff-free trucks, finds themselves squeezed by the raw material tariffs. They are paying more for the steel to build the truck that everyone wants. This is the stacking effect mentioned in trade compliance circles. It creates a price floor that no amount of efficiency can break through. Let's talk about the specific models. The Freightliner, Cascadia, the workhorse of the American highway. It's aerodynamically optimized, fuel-efficient, a marvel of modern logistics. But its production relies on a symphony of cross-border movements. Parts cross the US-Mexico border multiple times before the final key is turned. With the new enforcement regimes, every crossing is a potential friction point. The administrative burden alone, proving the rule of origin to qualify for any remaining exemptions, has added layers of cost that don't show up on the sticker but bleed the bottom line. Legal teams are now as important as maintenance teams. Customs brokers are the new forward scouts. And what of the vocational market? The garbage trucks, the cement mixers, the dump trucks. These are the vehicles that literally build and clean the nation. They are often highly specialized, with bodies built by one company and chassis by another. The tariff hits the chassis. Suddenly, a municipality planning to upgrade its sanitation fleet faces a budget shortfall. A construction company bidding on a federal infrastructure project has to revise its equipment costs upward. The inflation ripples into the public sector, into the cost of paving roads and picking up trash. The taxpayer ultimately foots the bill for the sovereign capability. It is a closed loop of cost. The driver shortage, a perennial issue, intersects with this equipment crisis in a dangerous way. Drivers want new equipment. They want the reliability, the comfort, and the safety features of the latest models. A fleet that cannot afford to upgrade because of the price surge risks losing its best drivers to a fleet that can. Retention becomes a battle of equipment. The large carriers with deep pockets can afford to eat the tariff cost in the short term to secure the best talent, further consolidating their dominance. The small fleet owner, driving a 2018 model with 1 million miles on it, cannot compete. The stratification of the market intensifies. We are seeing the formation of a Tier 1 logistics capability that is modern, expensive, and secure, and a Tier 2 that is aging, struggling, and vulnerable. Technology is the only force multiplier left. With hardware costs fixed at a high level, efficiency must come from software. We will see an acceleration in the adoption of autonomous technology, not to replace drivers, but to optimize fuel burn and asset utilization to the absolute limit. Every mile must be perfect. Telematic systems will be tuned to punish idling, to route around congestion, to squeeze every ounce of productivity out of the expensive asset. The truck is no longer just a truck. It is a precious resource that cannot be wasted. The operational tempo will increase. The pressure on the human element will rise. The global context cannot be ignored. While the US builds its wall, the rest of the world is adjusting. European and Asian manufacturers are looking at the US market and doing the math. Do they abandon it? No, it is too big. They will invest. We will see foreign direct investment FDI flow into the US manufacturing sector. Volvo, Daimler, Traton, they will expand their US footprints. This is the intended outcome of the policy, to force the capital to stay within the borders. But factories take time to build. Supply chains take years to untangle and reknit. The gap between the policy implementation and the industrial reality is where the pain lives. We are currently in that gap. It is a valley of death for cash flow. As we move into 2026, the landscape will look different. The initial shock will fade, replaced by a sullen acceptance of the new normal. The sticker shock will wear off, and the higher prices will just be ... prices. But the structure of the industry will have changed. The weak hands will have folded. The supply chain will be shorter, more domestic, less efficient, but more robust. The vulnerability to a factory shutdown in Asia or a cartel blockade in Mexico will have been reduced. The price of that security is what we are paying now at the dealership counter. The strategic question for every viewer watching this is, where do you stand in this new order? Are you relying on the old model of cheap, disposable assets? Or are you building a business that can survive in a high-cost, high-stakes environment? The tariff is a filter. It separates the resilient from the fragile. The US government has made its move. It has prioritized industrial sovereignty over short-term economic comfort. The fallout is real. The prices are real. The surge is historic. But history is written by those who adapt. Look at the used truck market. This is the canary in the coal mine. When new truck production stutters or becomes too expensive, the the used market reacts instantly. We are seeing 3-year-old trucks with 400,000 miles selling for prices that would have bought a new truck 5 years ago. This retention of value is a double-edged sword. It helps fleets with equity in their current equipment, but it creates a massive barrier to entry for new blood. The American dream of buying a truck and starting your own business is becoming a luxury item. The path to ownership is steeper. The ladder has been pulled up.